You're in back-to-back meetings all day long. You're trying to stay present, but you're also worried you'll forget the action item or the critical next step. That's where Granola comes in. Granola is an AI-powered notepad for meetings. With Granola, just jot down rough notes like you always do. In the background, Granola transcribes and turns them into clear, useful takeaways as soon as the meeting ends. You can even chat with your notes during or after the call. Ask Granola to help you negotiate, write a follow-up email, or even coach you using recipes. Once you use it on the first meeting, it's hard to go without Granola.
To say compliance is complicated is an understatement. Constantly worrying about SOC 2, ISO, HIPAA, CMMC, FedRAMP, and more can leave your head spinning. Even worse, a misstep can get pretty costly for your startup. That's why Delve is designed as an AI-native compliance platform. Delve uses AI agents to handle headaches like taking repetitive screenshots for you. Their team can personally work with you in Slack to get you 100% compliant and manage your whole audit for you. For our listeners, they're offering an exclusive $1,000 discount on any compliance framework. Check out delve.co/book-demo and start using AI for compliance. That's delve.co/book-demo and use code FinTech1K.
Hey everyone, even in 2026, when fintechs can spin up cards in minutes and move money across borders in real time, it's still hard to decipher transactions. That's why financial institutions turn to Spade. Spade is the data and AI platform that turns messy transaction strings into structured, verified records in real time. To learn more, head to spade.com. That's SPADE.com. Hey everyone, welcome back to another episode of Season 4 of the Fintech OGs. My co-host Lauren Crossett and I of Spade are so excited to have two lending veterans join us today. Mike and Ian, I will let you guys do brief intros, and then I'd love to know how you guys first met and everything too. I imagine it was probably like mid-2010s or something, but Ian, since I do not know you personally yet, I would love to have you go first.
Sure. Thank you for having me today. Really appreciate it. And it's always great to see an old friend like Mike. I'll be brief on my background. So we started the business, LoanStreet. I'm the co-founder and CEO in 2013. Before that, I was deputy chief counsel at TARP. And for some of your older listeners, they may recall that TARP was the government program that stemmed the financial crisis. You'd be surprised how many times people say they don't know what that was at this point, which is kind of scary. But so I worked at the U.S. Treasury Department for roughly 4 years, helped to roll out and manage those programs, and then ultimately left to start LoanStreet. And the original thesis behind LoanStreet was to help bring syndicated lending to community banks and credit unions. You fast forward to today. For our original solution, we have about 1,000 plus credit unions in the United States on it. And we've expanded, obviously, over the last decade. So now we offer syndication, marketplace, analytics, servicing for commercial and corporate loans. And there we work with U.S. credit unions, Canadian credit unions, U.S. private credit, U.S. third-party agents, and European agents as well. So we've really expanded the scope and types of clients we serve, but it's always around lending and always around financial institutions.
Very cool. Mike, what about you? Because you've also stayed in lending, but you've changed what kind of lending you do quite a bit from where you got your start to today.
Yeah, that's fair. And first, thanks for having me. Although we'll get into it a little bit more later, but we're actually solving a similar problem that I did with my first venture. So I've been in startups for about 15 years at this point, and my first company was called Common Bond. Common Bond was a fintech lending platform that focused on student loans, and over 10 plus years originated over $5.5 billion. Many of those loans were securitized and rated deals. We sought to bring down the cost of basically student loans that the government were providing. That's the main lender in the space, and we saw an avenue to help folks refinance once they got out of school and get them a better deal. I've done a lot of other things in fintech. I went into crypto as well. So I co-founded a company called Alluvial. That was the software developer behind the Liquid Collective protocol. That's in Ethereum liquid staking. It's a very esoteric concept, but it's basically a way to support a blockchain network. This is a proof of stake concept, and it just wasn't being done in a way where institutions could participate. It wasn't institutional grade. And so that's why we started the company, to make that institutional grade solution. And so it's accessible today where institutions keep their digital assets. So at companies like Anchorage, Kraken, BitGo, like that's where you can access the Liquid Collective protocol today. What I'm doing now is my fourth venture, and it's called Vault. And what we do is we're the orchestration layer that allows lenders to accept crypto as collateral for everyday consumer loans. So imagine today you're going for, could be any kind, really, personal loan, auto loan, student loan. And what we want is for the option for folks to be able to post some of the crypto they have, and increasingly so many Americans do. Over 20% of adults in the US have some form of digital assets, to actually post some of it to get themselves a better deal. This could be a lower rate. It could be a slightly larger or larger loan size. It could be the thing that gets them credit in the first place. Maybe they were initially declined and now they have another avenue to get that credit. We're the infrastructure that allows lenders to incorporate that into their process. And we'll talk a lot more about that, but that's the high level.
Only on Fintech OGs can you go from TARP to Ethereum within about a minute of each other. So how did you guys meet?
So what we would do with Common Bond, we're just trying to keep up with so many people that we started to have these happy hours at our office, which was also where we lived. So there are three of us, which includes my current co-founder, Nate, and then my co-founder, who's a CEO of Common Bond, David Klein. We lived in the back of the office. We kind of kept that secret for a while, but to folks who came by for happy hour, they knew this. And so that's where we had the office, and we said, why don't everyone just come over on Friday? It was a way for us to meet with, potential partners. MBA students would come by, and that's actually how I met Ian. One of our early employees knows him from Princeton and brought him by, and that's when we started talking. And one of the things that Ian impressed upon us was, ways that we could be more efficient with how we finance our loans, and that's how we learned a lot about whole loan sales, and that's very much what Ian was doing and helping credit unions to participate. Would you add anything to that, Ian?
No, except Common was definitely the cool startup back in the day, and so we were like me and my co-founder, we were the nerdy guys coming by at the cool kids happy hour, but nonetheless, created a lifelong relationship.
Ian, did you also live in the back of your office or no?
I did not. We didn't even have. We were so scrubby. We didn't even have our own office at that time. I think we were sharing someone else's office. We were pretty scrappy at the time.
It was like the OG WeWork then, basically.
Something like that. I think we were even pre-work. We were like literally sharing someone's, like we had a desk in someone's office. Was how we got started.
I remember a lot of Common Bond happy hours, but maybe like a little bit later.
We
had a big theme of community, so we did both the happy hours at the office, but a whole load of events over time. Yeah.
All right, Lauren, I'll let you. I've hijacked the interview so far, so I'll let you take the first question.
Are we just sticking with our normal?
Yeah, I mean, you can ask whatever you'd like.
What's a common thread that maybe keeps you two connected? What do you talk about these days?
Is it more TARP side or is it more Ethereum side?
Well, that's an interesting way of putting it, because anytime something happens in crypto that, let's just say Ian is crypto skeptic. I would put him in that bucket. But he's also open to learning. He's open to seeing the innovation. So he gives me many opportunities to explain why there's any utility in crypto. And there's so much noise in the space. So anytime something happens, I'll get a ping from Ian. I'll get an email forwarding, what do you think about this? It's some blow up, some hack, something happens in the space. So we talk about that. But then we've also talked about, things that we're both going through. If I'm fundraising or he's fundraising, or we're thinking about how, what's next for our business, we've just had this ongoing dialogue of supporting each other.
So you guys are one thing I've talked about in other interviews, and I think it was even the last one that Lauren and I did as well, is like having your own 911 list, like people, like a list of like 5 or 6 people that you're like, no, I know I can call them and they're going to give me good advice, talk me through this. So it sounds like you guys are on each other's 911 list.
Yeah, I always like to say, I mean, I know there's exceptions to this rule, but startups are not a straight line. Things go up and down. It's the real life. It's dirty. It's messy. And
They're
yes,
not overnight successes.
and like, yes, you can watch read an article about how this one startup went to zero to worth $100 billion overnight. And God bless those. That has not been my experience, nor is it, I think I'm free to say, for Mike either. And it's just helpful to sometimes have someone in your network where you can have an honest conversation about the fact that it's not always easy. There are good days, there are bad days. You win clients, you lose clients. And it's nice to have someone to talk to about the reality of running a startup as opposed to just the face that people put on that, like, oh, everything's perfect and I'm amazing and my team's amazing and we never make any mistakes and everything works perfectly. So I really value, there are a handful of people, I think, in the startup world that you can have those conversations with. I think it's pretty far and few between.
Yeah. 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 Because like, even though everyone goes through it, there's only certain ones that you know, have that sense of comfort with, that you know that you're going to be honest with each other, et cetera. And, you know, it's almost like a fellow founder therapist or something like that. I always joke, like, I don't want to be a founder, but if I did do a startup, I would almost just start like a therapy company for founders, where like they have therapists that specialize in talking them through all the things you guys have to go through. So if anyone ever starts that, you heard it here first. Question, lending in particular, I mean, every area of fintech has had its crazy ups and downs, but I feel like, you know, lending's one of the like oldest areas of fintech that we think of with fintech, 'cause people think of like Lending Club, and that area is kind of like one of the first time we started calling fintech really, right? Like you still had PayPal and whatnot before then, but it wasn't fintech then. Bloomberg was before then, and it wasn't fintech then and stuff. But, you know, talk me through how you've survived some of those ups and downs, because like, you know, Ian, you've had the same company the whole time. Mike, you've been in lending the whole time. Well, crypto, I guess, wasn't entirely in the lending, but you've stayed lending adjacent, at least the whole time. Talk me through like some of the ups and downs that you went through, and like moments of just like surprise, things where like, wow, that really caught me off guard. I was into, like, what did you think the space was going to look like when you first got into it? You know?
So if Mike, if you don't mind, I'll go first. So I will say what has like almost the comedy, and Mike knows this from talking with me, is that we've always sort of been running against the grain. So when we were launching, Lending Club was everything there was in the world. We work with tons of credit unions. I'd go to meet with investors and they'd be like, what are you talking about? Credit unions are going to zero. Look at Lending Club, look at Prosper, look at whoever. And I'd be like, no. Like credit unions are going to do a lot of lending. They do trillions of dollars lending. And I was told that I was crazy and that I was working with dinosaurs, right? And then so I would have to spend like pages of my investment deck talking about Lending Club instead of myself, because all anyone wanted to understand was how could I possibly exist when there's lending? And not that Lending Club's not a great company, but the idea that they were going to be 100% of lending is like a comedy. And then later on,
it'd be like if Stripe was going to be 100% of payments.
Right. But when you talk to VCs, they just sometimes there is sort of bandwagon, like it's hard to express to them that know that like depository, at the time, people did not think depository institutions were going to survive, which seems crazy now, but that was the milieu. And then, you know, when I later, it was crypto, right? It's like, we are not a crypto company. It's like, obviously credit unions are going away, lending is going away. It's all going to be on smart contracts. And so what has surprised me is actually how much we've always had to talk about things that we weren't versus what we were, because people can be very focused on the very hot thing, as opposed to, you know, we've seen a lot of companies come and go where they're chasing the hot idea as opposed to doing the heavy lifting of working with enterprise companies that are slower moving, that take time to make decisions, that, you know, you're not going to scale from 0 to 1,000 credit unions overnight. And so that has been the most surprising thing to me, is one, how much you have to work sometimes to get your story through when you're not riding the hot wave of whatever is exciting. Like now it's AI, right? Like we're not an AI company, but you can see people pivot. You can look at their LinkedIn profile. They were crypto, then they were machine learning, now they're AI. And it's amazing how their LinkedIn profile magically changes to whatever's hot in the moment. And we've really tried to stay the course of what is our thesis? Why do we believe that in the long term? And it can be very difficult at times to kind of hold to your knitting when everyone is telling you, hey, you need to pivot, you need to go do something else, because that's what the fun and exciting thing is. And so we've really tried to stay true to the fact of like what we know we are adding value and who our clients are.
Do you remember a moment where it was hardest to stick to what you were doing versus, people telling you to do something else? Because I'm sure each time you start to question yourself a little bit, et cetera. I remember it was Jack from Airwalks when I had him on last season, talked about their very early days. They didn't have any revenue or anything yet. And he had some people from Citi that were like, not on his board, but on the executive team. And they're like, this is never going to work. This is stupid. You can't do that. And instead of believing them, he just fired all of them. He's like, no, this idea is going to work. I'm going to stick with it and make it work. Do you remember any sort of moment where it was the hardest to believe in what you are doing?
We had, this was like, I would say a year or two into LoanStreet, we were getting credit union clients. We were seeing some success, and we got contacted by one of the largest players in the credit union space saying they wanted to partner with us. They wanted to invest in us. They wanted to give us access to their sales force. They gave us a pretty reasonable term sheet. And, obviously we were a small company, a couple of employees. And at the same time, one of the largest credit unions in the country approached us saying, hey, we see what you're doing. We would like to automate this problem. And so between talking with the largest credit union about doing implementation and converting their book, as well as talking with one of the largest players, basically ate up the entire quarter. We're like, all we were doing, we could barely maintain it. We couldn't do any other business development. We spent the whole time working with these two shops. And on like the end of the quarter, on the same day, on like Friday, whatever, March 31st, whatever it was, we got an email from the large player in the space where they flipped the term sheet on us from being an investment to being an ownership, where we'd basically be giving them the company for a job, which is not what we thought we were signing up for. And when we told them no, they said, that's fine. We've seen your business model. We're just going to copy it. And the very large credit union said, we've seen everything you've done. We think we can just build it internally. And they passed. And so we went from thinking we were like, oh my God, we're like finally launching this thing after a couple of years of having a large client and a large partner, both on the same day going to zero. And I remember sitting there, like, talking with my wife at night, being like, I think this is it. Like, if like the whole thing is falling apart, like, what are we doing here? And literally that night, it was like Friday night at 11 o'clock at night, we get an email from a different trade association within the credit union group that we had been selected for their like best ideas competition to present. And we're like, it felt like a sign from God, right? Like if on the worst day of the company's history, like who gets emails at 11 o'clock at night? There was like, hey, someone else thinks this is a good idea. We're like, okay, like we should keep going. But I think we came within inches of just quitting when those two deals fell apart. So that was like the lowest.
I wish you could name names. I want to know who this was, but NDAs are a thing. So yeah.
They know who they are.
There you go. I hope they listen to this.
But Mike knows that story.
Mike, what about you?
I have so many things in my head right now. Give me a good tee up for that. What we're talking about.
I mean, so you've done ups and downs, and you've had a few different ventures. Vault's super early, so you don't necessarily have to do Vault right now because there's a long story ahead of that one. But Common Bond had a very long life. I don't know as much about the companies in between those two, but when you think of ups and downs, moments where you're like, no, like we should just quit. This isn't going to work. Maybe it was when you were still living in that apartment, or maybe it was past that date. Maybe it was both, since there's lots of up and downs on a founder journey. But what comes to mind?
I mean, I think for us, so the story of Kanban was initially we did a pilot at Wharton. We raised $2.5 million of seed capital. And the idea at the time, the very beginning of the company, was it was alumni-funded student loans. We thought, okay, if you went to Wharton, you were alum of Wharton, you'd be willing to give students or recent grads a better deal. And so we raised the $2.5 million. What we found was it's really hard to get to acquire both the borrowers and the investors. So our model shifted to institutional capital. But the other thing that we found out was that we had applications for the full amount within 24 hours. And that was at one school. And so my model at the time said that we could place reasonably, if we expanded to the next 20, 25 schools, $100 million in our first year. We just needed $100 million. And so when I think about the pilot happens, that was great. We got some great validation from it. The next 9 months was, basically two guys going around Midtown trying to find $100 million from nothing. And we did that. We were able to find at the time, the banks, to Ian's point, they just weren't there yet. The larger institutions, the established players weren't there. So we were able to get a credit fund that really understood the credit story here. We're lending to Harvard Business School grads and folks like that who are employed. Okay. And they got the credit story. They gave us the $100 million, and that was hugely validating. Now, of course, with lending, you're always either I need more money or I have too much money because I have to get rid of this. I have to lend it out. So the next several months was, how do we get true product market fit where we are signing up as many borrowers as we're able to so quickly with the pilot. SoFi was out at the time, and they were sophisticating on their pricing. And, our financiers were not comfortable yet doing that. But then fast forward probably 10 months into it, where we are trying everything we can to lend out this 100 million. And it was really tough. We made one tweak where we started doing risk-based pricing, and all of a sudden the floodgates opened. And I remember everyone in the office was very excited about this. I became terrified because I said, we're going to run out of money like immediately. So then it became a full court press to get even more money. And we ended up getting another 200 million over the next few months. And the company kind of, went from there. It's this seesaw of getting more capital, lending it out, doing it efficiently, and building a business around it. As far as
actually, with the low, I want to ask you about COVID, because that's kind of like, you had left Common Bond at that point and were doing other things, but you still, own part of the company, etc. There were other founders that went through similar things that you did, and maybe it wasn't COVID for them, but something that there's just no way you can predict something's good like that. There's no way that was on your bingo card or anything. It's like a risk for you, for your investors, anything. How did that feel as a founder, and how did you kind of learn from it, make your way through it? Piece of advice for someone that maybe has something like that come up going in the future.
Yeah, I'm hard pressed to know what I learned exactly from it, but it just solidified the point that there are, I think back to Donald Rumsfeld when he talked about the known knowns, the known unknowns, and then the unknown unknowns. And this fell in that third bucket where you just couldn't predict a pandemic coming in and what that would mean from a policy response standpoint. So for context for the listeners, right? Basically, the company is doing well going into 2020. They're actually celebrating. At this point, I'm not at the company, right? So I'm getting this secondhand, but they're celebrating the fact that the main business line is profitable. And during that celebration, the head of HR pulls my co-founder Dave into a room and says, I think we have to close the office because the pandemic was just rearing up. And what then followed, besides the remote work, which was arguably fine, was obviously a lot of volatility in the market. So I'm already a little nervous about what this means. And the response to it was zero interest rates, which at the outset made a lot of sense. But it became something that first the Trump administration and then the Biden administration both relied upon because very, very viewed very positively by young voters and young borrowers to keep interest rates on federal loans at zero. We're a refinancing company, so why would you ever refinance when rates are at zero? And so that hurt the company, and it's just started to bleed cash. And there are other opportunities like focusing on other private student loans as a refinancing target, kind of trying to make it so that it didn't matter that the government was doing this, but that was a large part of the market. And ultimately, that's what befell the company.
Mm-hmm. Right. Yeah, it reminds on a smaller level, something that happens to there were a lot of restaurants in big cities that ended up having to close because there's just no way they, if you can't serve people food, you can't why would someone refinance a loan then? What are you going to do? So, yeah. Okay.
Maybe staying on that vein, outside of a pandemic, what are some other big surprises that you've seen in your tenure in fintech? Maybe Ian, we'll hear from you first.
Surprises besides COVID and fintech.
Well, even like an upside surprise and a downside surprise or something like that. Like something where you're like, wow, like that's so like we've gotten that already. That's so cool that fintech was able to do that. And something like really like we still like can't easily move money instantly. Like what is going on here? Those kind of things.
So I would say what is one maybe under the water journey that sometimes people are completely unaware of is like when we originally started the company in 2013, we started on AWS. That may seem completely unsurprising at the time. The idea of a cloud-based solution going to community banks and credit unions, I mean, they assume genuinely they would say it was unlawful. And they would say, why would I use a book company to host my software? Like they had never heard of AWS before. They thought Amazon sold books. And now, if you were to go to a community bank and a credit union and say, hey, I want to install something on-prem, I think they look at you like you were crazy. And so that is a really behind the scene thing because, to the consumer, everything's on their phone and they haven't really thought about like every interaction they've ever had with a fintech was either online or on a phone. When you were selling to institutions, it's amazing now how much things have changed where originally people would literally call me up and say, I love the solution. Can you send me the CD? Like they didn't understand that you would actually access our platform online or that was even lawful. And now the opposite occurred. So I think it's been really interesting watching how much more open today financial institutions are to fintechs and web-based solutions. And the sea change, I would say, really happened actually, ironically, around COVID too, where there really wasn't a choice. There really was this idea that like 5 years worth of, forward thinking happened during COVID. And so I think it forced, like that was one benefit of COVID for a lot of fintechs, is it was a forcing function for a lot of institutions. Well, if we're going to close all our branches, we do need to have a digital footprint. If we're going to close all our branches in our office, our operations staff can't use on-prem software. And so while at the time it was extremely painful and like Common Bond, like all of our clients were shutting down and we're not using our service and we had to do other things to, stay alive. Once we got through that initial pain, the switch to how people think about technology at the institutional level has been dramatic.
Mike, any other surprises?
I'd say I actually think about two things when you give that prompt. First, to Ian's point about how at the time it seemed nuts to be using AWS, and now it seems nuts that it was ever anything other than that. Online lending as a concept was strange at the time. I'm going to borrow money over the internet. Like that now seems nuts for me to say. That's just how it's done today. So like, I'm very proud to have been part of, and Ian as well. Like we're just part of this movement to make it easier for people to get access to credit. But there was a time when that wasn't as readily accepted as it is today, as obvious as it is today. And the other thing that I think I'm pleasantly surprised with is kind of leaning more on the crypto side, just the acceptance of stable coins and what that means. So crypto starts out and initially Bitcoin is going to be this payment network, and that really never happened, right? People now have moved to it's a store of value, and whether or not you buy into that, I think that has more resonance than its use as a payment network. But what stable coins represent is huge, right? I can take a dollar and truly not just digitize it, because dollars are really digitized at this point, but more use a form of a digitized dollar over blockchain rails, which means I can personally send money to Ian in, a matter of a minute if I want to, and it's going to arrive in his self-custody wallet. That's incredible. But that was mostly being done by more crypto native people. I'm doing it, but I'm a small subset of the population. The fact that so many large, very well-known institutional players are either in the space or trying to figure out how they can use stablecoins, the fact that the Genius Act is passed and that we now have some more clarity on how this is going to work, that's a huge breakthrough, and that's a pleasant surprise that we've gotten this far.
Yeah, certainly. Ian, don't hate me or hold this against me. I do work at a data and AI company, Spade. So I feel like I have to ask, right? Like, what do you what is your answer to how are you moving into an AI shaped future, and how does it impact your business? I totally respect that, like, you are not an AI company, but how has it changed maybe operationally or how you do things in that same way that AWS changed everything?
If you want to have some buzzwords in a funding round, just add that you are an AI company, though, just to be clear.
So I will admit, like, I am a bit of an AI skeptic, but I am much less skeptical of AI than I was of, say, distributed lending, taking away depository lending, or
Are you more skeptical of crypto or AI?
crypto, for sure. I'm actually much less like so I'll give you my so one we use like I'm sure every other startup, AI is used by our engineers to move, generate and be more productive. I think there's a lot of learnings our company has to do to get better at it, but we think about it all the time. I talk with our engineering team, everyone. There is no doubt that it is a tool that every engineering team is going to use. And we have conversations internally about what our first client-facing AI features will be. I don't think we will be an AI platform or even some type of layer on top of AI per se, but there is without a doubt use cases that our clients would benefit from where we could embed someone else's model, whether it's Claude or whatever one works the best, or let them have their own options. I don't think we fully thought it through, or even that there could be even more than one answer where what a client-facing feature might look like. So we use AI at the company. I suspect by the end of the year, we will have some features that are supported by AI. I guess where I'm a touch skeptical about AI, and then I'll circle back, is the closest thing we've seen to the type of productivity gains in the world ever would be Moore's Law, right? Where computing power doubled like every 18 months for like 40 years. And Moore's Law is basically over. And, people want to quibble with me, fine, but it's basically over. Not that you don't see continued improvement, but not at the rate it was before. What people ignore about Moore's Law is that parabolic with the compute power was also spend, right? So if you look at number of engineers and R&D spend from the beginning of Moore's Law until today, it also was parabolic, right? They were doubling spend every 2 years in order to double compute power. We simply cannot keep doubling spend on AI. And so the idea would be that in the first time in the history of the world, right, where we could improve something's performance by doubling every 18 months without doubling spend, I don't believe that's plausible. That doesn't mean there won't be improvements. It doesn't mean that people won't find ways of adding it. But I'm very skeptical that where we are today, we're going to continue to see doubling of improvement indefinitely without doubling spend. I mean, if you look at the amount of money that Microsoft, Google, Facebook are spending, you could probably double that once. There's just not enough money in the world to double it another 2-3 times. Like, it just doesn't exist. So that's why I'm a bit skeptical that we're going to continue to see the pace of change, right? But that does not mean that what we don't have today already isn't amazing and it can't be further refined and used as a tool. And I think I would be crazy if my company wasn't thinking really hard about how to incorporate it into our solution. All that being said, I think when it comes to enterprise software, clients are very uninterested in probabilistic outcomes, right? If I am telling someone that the amount of interest due on March 31st is X dollars, that can't be 99% right. It can't be 99.9% right. It's just got to be right every time. And there can't be a different answer sometimes, right? Like, there's zero interest in certain parts of financial institutions, whether it's accounting, invoicing, events that have occurred. Like, there's just zero interest in probabilistic outcomes. That being said, there are areas where probabilistic outcomes are totally fine. And I think the savvy companies are going to figure out where a probabilistic outcome that's 99% right is an amazing part of a workflow that's better than what the human can do. And there are parts of it that there's just zero interest in. And if you can combine those two parts, I think you have a winning combination. And that's what we spend a lot of time thinking about, is like, where can we add probabilistic outcomes that are very, very good next to things that have to be right every time?
We sell probabilistic outcomes, so.
Good news for Spade. Mike, I hope you don't have Ian's number stored as Ian Lampl. You need to have it stored as Devil's Advocate in your cell phone, because he's literally just call him for Devil's at anytime. But how do you see AI transforming lending over the next, 6 months to 6 years?
Sure. Well, first, whether the current players in the space have the right business model and will be able to grow at a certain clip is less interesting to me than what we can do with it today. So kind of like Ian and LoanStreet, like we're very AI forward with how we're doing things. I find it completely invaluable. It's like just the best chief of staff possible for an early stage founder. So we use it and are increasingly incorporating it into everything we do. We're building our product, of course, with it, but I use it just on a daily basis to do all sorts of things. One of my more recent examples is I was doing this analysis on Bitcoin volatility, and what I wanted to show, because this comes up with lenders, but what I wanted to show is what it would look like if lenders had actually made crypto-backed loans over the course of the last 7 years, and how protected they would be in ups and downs. And I'm a Excel power user, and I needed, to Ian's point, I needed to get it right. So I did it on my own, and this was millions of cells. It ballooned to 172 megabytes. It was one of the largest, if not the largest model I've ever made. And I was saying to Claude, this is the state of things, and said, yeah, that's a really large file. Like maybe you can explain exactly what you're doing. We do a Python script, and I couldn't upload the model. I couldn't show it what I had done, which you would have thought would have been necessary. I just explained what I did, and the first go at a Python script, it nailed my ending balance at the end of 7 years to the penny. And it was an 18 kilobyte script with more flexibility than the model that I had built. And that kind of analysis would normally take me, probably weeks. I was able to do something, I was able to do a lot of the analysis work for that overall project in a couple days. So that it's just changing how startups can move, and it's incredible. As far as lending goes, I think we're somewhat defensible from AI because there's a lot of regulatory moat there. So, and I'm glad. So, being a provider to folks who are have regulatory concerns and considerations gives us some stickiness that I think maybe some other industries will struggle with over the next few years. I do think. And Ian basically acknowledges too, like the growth will continue. I don't know exactly what it looks like, if it's going to double per se, but the improvement's going to continue to be there. Are we going to get to a point where, I hear a lot about, the agents are going to be involved and we're going to have AI-based lending. I think for the regulatory considerations, I'm somewhat skeptical that that's going to happen anytime soon. But I mostly see it as the productivity gains as a startup that we're able to incorporate today. And it's wild.
I think it also just depends on like which part of the lending stack you sit in too, right? Like the servicing side, I've seen a lot more AI stuff than, actually going through and making the loan. Makes sense. But on the servicing side, it also makes, companies like Spade so important just because they clean up the data and make it digestible. If you have the wrong data, AI is not going to do much for you. It's just going to give you wrong answers, and it's pretty important to get the right answer too. I guess we only have a few minutes left, so I want to ask one more question, and that is, what are you most excited about in fintech right now?
Mike, why don't you go first? I've been leading a lot of these.
I mean, I'm going to be a little biased.
He feels bad for saying so many bad things about crypto, so he's like, okay, you can go first.
He does not. We will continue to have those conversations. It's fine. What I mentioned this at the outset. What we're coming back to with Vault is what I'm so excited about. That's why I'm pouring my life into this. When I started Compound, one of the tells that we were on the right path was when I applied for my second year MBA loan, I was declined on the basis that it didn't make enough income. And I was like, well, I'm a second year MBA student. Of course I didn't have a good year last year, like I was in school. And it just kind of showed how broken the system was. But the other thing that I learned from that was they did not care about the assets that I had. They didn't factor it in to the credit decisioning process at all. So lending today is basically based on data, credit score, what's your income, debt to income ratios, maybe cash flow underwriting, but lenders largely don't look at the value that you have, because you could go to Vegas tomorrow and basically spend any of the assets or savings that you have. If in fact, it's not pledged. That's what would need to happen for a lender to incorporate it. But if you think about the pledging process for most assets, like moving your brokerage account, I mean, that just doesn't move at the speed of a modern loan application. That's what we're hoping to change. And that's the reason why we're using digital assets as a proving ground, because nothing can move at that speed. You could you could go through a loan application, and within a couple of minutes send the required crypto to the qualified custodian account that we've partnered with, where the assets remain during the life of the loan, and now get a lower rate on your personal loan, on your student loan, etc. We just love the idea that we're actually going to bring in the value that folks have into the credit decisioning process. And I just think this has huge ramifications for lending. And that's why we're working on this.
Ian, you close this out.
Sure. I think, well, I started off saying like I was a big fan of depositories and skeptical of Lending Club, even though I think it's a wonderful company. Actually, I'll take the other side of that for my closing remarks, which is, well, I don't think depository institutions are going away.
Is that allowed? Is this allowed?
Continue
Can
to
you
do
that?
Yeah, I can take I'll take.
He's devil's advocate. He's got to do it to himself.
I think that what is similar to what Mike was just saying is that lending is actually becoming very democratized, right? And that there are lots of different institutions doing lots of different types of lendings, where maybe historically all lending would happen at banks or at credit unions, and now there are different type of lenders, right? And some people call them shadow banks or private credit, or in some ways, Lending Club was an early private credit, right? These were non-bank lenders lending to consumers, and Apollo's lending to middle market companies. I think there's different types of capital sources for different types of loans for different types of borrowers. And I think we're going to continue to see fragmentation in lending and who does different types of lending. And I actually think that's incredibly healthy. I think it diversifies the different sources, makes our economy much stronger. And it's a source of strength for the US, right? We have an incredible diverse capital markets where there's lots of different types of credit products being provided by lots of different parties. And at LoanStreet, we'd like to provide infrastructure for lenders to diversify and manage capital. So for us, what we see is an incredible diversification of capital providers, and we think that's a great thing. We think it's great for fintechs. We think it's great for small businesses, medium, large businesses. It's great for U.S. dynamism. So I'm a big fan, and I think even if I am a believer in traditional depository institutions, I'm also a believer that, and we're going to continue to see a positive fragmentation of the lending ecosystem.
Amazing. I love that. I love ending on a positive note. So thank you, Ian. I appreciate that. Well, thank you both of you for joining us. I'm really excited for this episode to air, people to learn more about, diving into the lending industry. And you guys both have been in fintech for quite a while now. So you have really good insights on where we've been, where we're going, and what's to come. I appreciate it. Thank you.
Thank you for having us.
Thanks, guys.